Hey everyone, welcome to episode 77 of the Julia La Roche Show. I am pleased to bring to you this conversation with Harold Bradley. He is the former Chief Investment Officer of the Kauffman Foundation, and if his name sounds familiar, it's because if you listen to episode 76 featuring Herb Greenberg, he gave Harold a shout out for the work he did several years ago that is pertinent to today around exchange-traded funds, ETFs, and the systemic risks they pose to the public equities market. In this episode, we do a deep dive into ETFs and the danger they have, especially toward capital formation. I learned a lot in this episode, and I especially learned a lot about Harold and some of his pioneering work throughout his career, and I certainly enjoyed it, and I think you will too. And if you're new to the channel, welcome. It's so great to have you. If you haven't done so, please be sure to hit that like button and ring that notification bell so you won't miss any future episodes. The show is completely free, and your support will help me bring in some more amazing guests. And if you're listening to the podcast, if you don't mind, please be sure to leave a rating and a review so you can help more folks find these episodes. Again, thank you all so much for your support, and I hope you enjoy this conversation with Harold Bradley. Harold Bradley, an investor with more than 30 years of experience, a critic of market structure, and a pioneer in electronic trading, among other titles. Harold, it is so great to welcome you on the show. Thank you so much for joining me.
Well, thanks for inviting me to be on. It's my pleasure.
Well, I'm excited to have you on, especially since I had Herb Greenberg on recently, and he mentioned you, and I was just talking to you about all of the things you've done over your career. And, you know, you and I even have something in common. I know you studied journalism and you were a reporter for a period of time as well. And I was mentioning some of the work you were doing, a pioneer in electronic trading, a critic of market structure. I know you have spoken out about the risks in ETFs, but I think, Harold, to start this conversation, can we kind of frame up, or you frame up, your career, your experience for the folks who are watching and listening? Just provide a bit of context about some of the work you've done over the years.
Well, so I have a pretty high-powered lawyer friend who was a high school classmate of mine in Kansas City who describes me as having the most, he shakes his head in disdain and disbelief and says, you have the most improbable career path of any human being I've ever met. So from my place here in Kansas City, I went to Marquette University Journalism School, and I started working for a small company called Commodity News Service. It wasn't small; it was owned by Knight Ridder back then, which was a great big newspaper back when they published newspapers. And I happened today, I saw that that the wheat crop in Kansas was just reported today is one of the smallest in 40 years, and that we are like at a 16 or 20-year low in carryover supplies of wheat to feed the world, right? Hard winter wheat in Kansas feeds the world. So I learned by getting on the field as a reporter, and I would tromp around wheat fields and corn fields and soybean fields with leading kind of agrarian agricultural economists in Kansas and Iowa and Illinois. Every year they'd have a tour to kind of estimate yields, and it was all so fascinating to me. And that's how I learned about markets. I learned that you killed grain 3 times a year every year, and prices rally, and then bumper crops come in. From there, so I spent 5 years. I was a reporter at the Kansas City Board of Trade, and I used to kind of walk into the CEO's office there. It was a minor exchange traded just hard winter wheat futures. And I would bug Walt Vernon to death. He was the CEO, and I'd go into his office saying, why don't you do this? Why can't I get this kind of information? Why don't you provide this to people? You're trying to start this brand new thing called a cash settled stock index futures contract based on the value line index. Took 5 years for the exchange to get it done back in 1980. And he said, well, why don't you go to work for me? I'm like, okay. So all of a sudden I'm going around the country explaining to these great big heavy hitting folks at Ackley Commodities and other places what a stock index futures contract is that's governed or regulated by the CFTC. And we were the first to go. There's some really interesting stories around there, but I don't want to go any further. That'll take me off track. But like, we spent all that time and money. I learned about how little exchanges get squashed because they do all of the innovation. That was the Midwest Stock Exchange reputation for decades. And then as soon as they win, the New York Stock Exchange comes in, takes it. The Chicago Board of Trade comes in, takes it. In the case of stock index futures, the Merc came in because originally there had been agreements done with the S&P and Kansas City, but then things didn't work out in negotiation, and the Merc locked down the S&P, and clearly that won. So I could go on for that forever, but you can tell how all of those were the beginnings of a major structural shift in, I would argue, computer technology. Okay, so when I started at the Kansas City Board of Trade, we still had guys that were on these catwalks, and they had headphones on, and they were listening to the court report, the pit reporter, who would say, "Oh yeah, we just traded at $2.34 and a quarter." Yeah, and then somebody's up there with, they're just literally writing in chalk, wiping it off, writing in chalk, wiping it off. Then they'd say, "Oh, fast market," and so fast market meant nobody who was calling in could depend on the prices. That's what we had back then, and then these great big companies started making a lot of money by putting electronic trading boards in place. Now, the people, these young people today who are using Reddit to see the last sale, I mean, this has all taken place in my career in investing. It's barely, so I'm 66, so I would have been, 27, 28. So let's call that 35 years. The pace of change, so Moore's law, right? Processing speed doubles every 18 months at the same cost. That's a geometric rate of change. And people cannot even understand, one, how much has changed if they haven't lived it, or two, what it took in terms of personal courage. And I could name a handful of people who take on the whole system because it was not in Wall Street's best interest at any step, at any time in the last 30 years to adopt technology without being forced. So there, that's my opening statement.
I like that. And feel free to go as long as you like. There are no rules on this show. You're allowed to answer as long as you'd like.
Well, I don't want to bore people to death with my history.
I don't think it's boring. I want to ask you something because you made a good point talking about like the personal courage to take on the whole system, and that was not in Wall Street's best interest, kind of like this adoption of technology. Can you expand on that a bit more? Can we dive into that? I want to hear more on that.
Well, yeah. So how did I make it out of the wheat pit and into and into equities, if you will, where I spent most of my career? So we started trading the value line in 1980. I was on the staff at the Board of Trade until 83. And a guy walked in my office, now deceased, a guy named Jim Henson, and he said to me, "Harold, what can you tell me about trading stock index futures?" I said, "Well, I've been teaching everybody." I said, "Not many people know about it yet, and we're just learning." And he said, "Will you trade for me?" So he literally sponsored me, and he paid me $50,000 a year, and I was making him significantly more than that. But I was a terribly naive dope, but I thought, here's an opportunity to get somebody to pay my tuition. So I spent 2 years trading for him, and then realized that I would be in far better shape if I went ahead and took the risk to be a floor trader. So I approached my father-in-law, now deceased, and my dad, and I said, "Will you guys front me the money?" And they literally, one had the security of my membership. The other was a personal note, and I figured at that age, I'd have 50 years to make it back and pay him back if I lost it. Little did I recognize the leverage involved. So there were some harrowing stories up front. I started off in a terrible situation and recovered quickly. Luckily, nobody really knew. So the other thing that I did, that's back when we were trading German Deutschmarks. We didn't have the EU, and I bought calls on the Deutschmarks before a vacation, and my father-in-law drove around. We shared a trading account, drove around a fully outfitted van for family vacations for the next 15 years. that we paid for with that trading profit. So literally, I had people that were betting on my smarts because I wasn't, or my, I don't know, even maybe it was just on, maybe it's just love, who knows? But they had no guarantees at all that I would succeed, and I don't think they even had a sense of how much leverage was involved that could have, wiped out their capital accounts for a while. And I don't think I did either until 1987. And in 1987, when the Fed started tightening like they just did, the markets had gotten way ahead of themselves. The economy was percolating along. And I was on the trading floor that day. And literally, it is one of the most terrifying memories I have in my investment career. And subsequent to that is I can get kind of emotional and excitable. And that's why you really use computers, because the computers, I can tell the computer what to do and then do what it tells me when I'm feeling whacked out by what I'm observing that doesn't make sense. But in 1987, everybody came in the morning on Thursday and Friday. The markets were down hard, and everybody thought this was a buy. And I don't know if there's people talk about Louis Rukeyser used to do a show called Wall Street Week every week. And Rukeyser used to have what were called the elves. And the elves were his technical signals that said, all's clear, get out, run for the exits. And I went home long that night, some futures contracts, because I thought things were just down too much. And the elves were screaming, -5, sell me. And then we opened on Friday or on Monday, which was Black Monday, October 19th. Mm-hmm. And I watched people lose everything that day. One guy over the course of many years left the earth because of what happened that day. The people don't recognize the lack of technology tie-in. The way I was trading is I was trading value line stock index futures in the pit in Kansas City. And I had a guy on a phone with headphones on who had 4 or 5 other locals that he did that for. So I make a trade for 10 contracts and say, sell 10 in Chicago. And he goes, fast market. And there were times during that day that I thought I'd lost as much as $200,000, which I didn't have to lose, because the market went down 5%, up 2%, down 10%, back to unchanged, and finished the day down 22% in the Dow. It was one of the most volatile days. They blamed it on portfolio insurance. So much of my sensitivities around the reason we had our initial conversation around ETFs, which is a form of portfolio insurance, was because I was on the floor that day. And I know what happens when people think they can seek liquidity through arbitrage that isn't there. So that October 19th, I'm like, man, oh man, it destroyed my confidence on the trading floor. It also chased away liquidity for a number of months. And I I started looking at job postings. And there was this company I didn't know at all called 20th Century Mutual Funds, run by Jim Stowers, that had a great 10-year track record, one of the best in the country. And they were advertising for a buy-side head trader. And I went in and interviewed with them, spent an hour talking with Jim Stowers about the Japanese yen strength against the dollar, all sorts of things that were not typical in conversations. And then I didn't hear from him for 4 months. And I called him back and said, hey, I guess you found somebody. So sorry, so sorry I couldn't help you, but thanks for the interview. And they said, well, come on down. And then they hired me the next day. And so for the next 20 years, I worked at American Century, and we became one of the, and this is an audacious statement. Mm-hmm. We became one of the most technologically proficient trading organizations in the world for a buy-side firm at the time. And my story on that is that Jimmy Stowers said to me, the son of the founder, Harold, he had a computer degree from Arizona State, I think. And Jimmy said, I want you to get rid of all these tickets. I want you to make complete electronic our trading. We had nothing. When I got there, I was on a cafeteria table in a room without windows. And over the next 5 years, we built out, and he gave me unlimited. I mean, I didn't have a budget. I had unlimited technology resources. But I'll never forget when the Goldman guys came in to try and sell us a cross-currency trading platform, and I showed them what we had. And this was probably in, I'll say I went to work there in 88, probably in 91 or 92. And they looked at it and they said, how did you do this? Because I had it calculating our back office costs. I could check and see whether they were not Goldman. But at the time, if there was ever an error on an international currency ticket, it was always in favor of the dealer, never in favor of the buy-side firm. And because it was so complex, all the countries' rules were different, our algorithms told us exactly what it would be for every country. And they just couldn't believe it. I think to this day, it's because Jimmy was particularly brilliant on seeing what was going to happen next. I was emotional enough that I wanted to tame my emotions through the use of technology and systems. And then as we got this done, we're out in the middle of Kansas City. It was a little bit like the Soviet Union competing with the United States back then in the previous time that happened, trying to figure out who was ahead in the arms war. And once Reagan beat them, it was like, well, they weren't even in the game. Once we found out, how far behind they were because we'd been running so fast. At American Century, I felt the same way. We were running so fast because we thought we were so far behind, but everybody else on the street was not. Okay, so that was how we were wired. Where that becomes courageous is, one, I wanted to trade electronically and nobody on the street wanted to. So bring in the FIX protocol. So the FIX protocol was started by Fidelity in a box that they have on people's trading desks around the world, the sell side, Goldman, First Boston, Merrill Lynch, those guys. And the FIX protocol was called the Financial Information Exchange Protocol. And what it was really doing is saying, let's create a common open source language to where, Julia, if I wanted to trade a stock with you, you and I would talk the ticker, the price, limits, it would all be done that way. And then we built direct links to all these dealers because the internet broadband wasn't there yet. And in doing that, it was very, very threatening to the way the business had been done, which in New York at the time, if I needed to sell 1 million Oracle, I called up Goldman Sachs or Merrill Lynch and said, I'm selling 1 million Oracle. And then they put up on the board in New York in front of everybody to see. They would call out to all their customers saying, I have a seller of 1 million Oracle, which I never understood how that was in my best interest. So we built all of our stuff to be private and anonymous. And we did a lot of tracking. Jimmy Stower is probably one of the first to really rely on FEI as a trade cost measurement company. And the more of this stuff, and the reason we were doing any of this is SEI said we had the worst trading costs in the country when I got there. They didn't have a trading desk. Mm-hmm. They used to be called the Wednesday traders. They would just take these huge institutional orders, give them to a handful of brokers. Everybody knew who the handful of brokers was. And they were literally trading in the footsteps. And what we did over the next 10 years is just sucked all that away. What I did is took it public. I took it public and people said, well, why would you do that? And I'm like, because I think we're so good. I want to see you beat us at our own game. And so the confidence we had that we could trade effectively using electronic systems really mattered. So we were heavily engaged in the FIX protocol, which changed trading in foreign exchange. It changed trading in global equities. And it is now, I believe it's still the ubiquitous standard that a lot of these things tie to. In fact, Scotty Atwell, who was just this 20-something-year-old software coder who came onto my team, we did a CD that he sent me 4 or 5 years ago. He said, I found this, you have to listen to it, where I laid out a vision for what would happen if we did these things. And Scotty is still the chairman of the FIX Technical Specs Protocol. He may not be now, he was 3 or 4 years ago. So anyway, that's a
well, wait. He brought you a CD with your prediction. Wait, what? Can you explain? What did you say? What did you say at the time?
Well, it was a vision meeting. And I cursed too much on it. But the vision meeting was, if we build this systematic way to communicate how we're going to trade, do it electronically on our trading platform, on our proprietary trading platform, we can beat everybody, and this is why we will win. By reducing order size, by reducing market impact, nobody will know our intentions, nobody will know our size. And so when he listened to it, he was so astounded. It was like 20 years after we'd done that he sent it to me. He said, it was so cool, because we were talking through what could be. But it was a dream, and many firms in investment management do not dream because they're trying to maximize their profit take. And many of them view the flawed structure of the system as where they make money. But I would say at American Century, Jim Stowers, who's now deceased as well, a lot of these old guys who I just loved, Jim was brilliant. He actually coded the first American Century algorithms in his bathtub because he figured it was easier for him to learn COBOL than it was to hire somebody with COBOL that he would then have to teach what he wanted to do in terms of investing. So when you think back at that, and then this legacy we left all the way through, one of the things Jim did at American Century that I found amazing was a unified fee. So fees are still a huge problem in the mutual fund industry. And in a unified fee structure, he said, we charge 1% for everything. At many other firms, it was 15 basis points, 20 basis points, 30 basis points here, 40. If we charge a 1% fee on our assets, but our costs go up, we make less money. So our margins were always, the guys at the executive level were always worried our margins were not as high as what others had. But Jim said, this aligns us with our investors. And the reason that I was there for 20 years is that the culture of that firm at that time, and I don't know what it is today, so, but at that time, the culture was, we work for the investors of this company. They matter first. So all of the stuff that I was doing was a function. I would represent that we were working, that I had 1.5 million investors, and that's who I serve. And that was just, the Wall Street guys couldn't understand that. So I don't want to sound sanctimonious. I don't want to sound perfect. Many people who you've talked to would say there's clearly I wasn't, but they could never figure out why we had that motivation. Everybody wanted to understand. They couldn't figure out, who are these guys?
Well, why do you think that was?
Why did they? Because nobody else was doing it.
Yeah.
They were all
just the
they
innovation.
all thought that the flawed system was a bug, was a feature, where we thought the flawed system was a bug. And I worked my entire career to kind of overcome and fix those things. So where that really comes up is soft dollars. So soft dollars, for those of you who watch the show and you're still in mutual funds and not in ETFs, if you are in a mutual fund, those firms use their commission dollars to buy services, computers, all sorts of stuff that, quote, is related to research. Okay, how do you constitute research? So my favorite thing on that is I started, so 2 stories I would tell on soft dollars, which became a whole kind of mid-90s. I was on tirades, and I talked at national conferences on reeling in and making accountable firms who use soft dollars, because you charge a fee of 1%, and then you took the commissions from your investors and spent it willy-nilly on commissions with no accountability. So there was no incentive for those firms who were deriving direct economic benefit from trading with brokers, because they got soft dollars is a happy term for kickbacks. You pay back then 12 cents a share, you get 4 cents a share back in commissions. Why would you internalize your trading? Now, I viewed it as we were making a whole lot more back by what we were saving based on this trade cost analysis that we did. So, there's a Business Week article that is now hanging on the wall of my office, where Arthur Levitt, who was the chairman of the SEC at the time, is in the bottom, and for some reason, somehow, I'm at the top. So I spent a lot of my career thinking that I was on Sesame Street, where they say one of these things is not like the other ones. I never kind of understood, how am I here? And I really think the difference was, and it ties back to my journalism, which you talked about, is that I was willing to talk on the record. So most of the people on Wall Street who took shots at me my entire career said, he's full of baloney. Okay, can I quote you? Oh yeah, I'm an anonymous source from Boston. Oh yeah, I'm an anonymous source from Chicago or New York or San Francisco. I always talked on the record, and I always told the reporters, here's who to call. They'll be on they may not go on the record. Here's what they'll say. This is my perspective. I'm on the record. If anybody wants to take me on the record, have at it. And so the courage part, and again, I'm self-congratulatory, right, when I talk about, that being courageous, but people didn't do it because they didn't want to upset. If you were really dependent on Wall Street for making your big block trades for you, you didn't want to upset them because they could hurt you in a whole lot of ways till Sunday, even though my sense was they already were. Mm-hmm. So going to the electronic trading, people they couldn't figure out what's the motivation. And so I kind of kept that up all the way through my career at, I got to know the SEC extremely well. The order handling rules for NASDAQ. So I was out to dinner in Washington, D.C. with Rich Lindsay and Annette Nazareth, who worked for Arthur. And I scribbled on a napkin what we were doing and how I would think about creating these order handling rules. They may not remember it that way. That's how I remember it. And then over the course of the next 2 years, they did a number of public comment letters, which created the order handling rules, which were the first regulatory gateway. They removed the barriers to having electronic trading systems. Back then, they were called ATSs, or alternative trading systems, or ECN, electronic communications networks. There were all these different views. But we were a driver. We were Instinet's largest customer at the time. My badge, I-49, was kind of I still take that with pride, because when you call in, they had a big trading desk, and somebody would scream out to Doug Atkin, who ran it at the time, it's I-49. Well, Doug wasn't, actually, he was just on the desk. But I was one of their largest trading customers. And we helped drive commissions down doing that. I got a call one day out of the blue. Actually, we'd heard about, I had Rich Lindsay, who I loved. He was a very serious economic. He was the director of economics for the SEC. He called me up and he said, have you heard about Archipelago? And Archipelago was a startup company, fully tech, in Chicago, being run by a guy named Jerry Putnam. Jerry became a huge friend of mine over time. He was unafraid. And boy, they did everything in the media to try and just all these guys who did this stuff were just get that, just like today. It's worse today because it's instantaneous and it's amplified and it's retweeted and re-amplified, whether it's true or not. But back then, it was in the Journal or Business Week or Barron's, and it'd be rumors that would be picked up, and it's like, okay, we'll be on the record. I always felt like if I was on the record, I was cool. Anyway, you got me. I've gone way too far here. Those are some examples of courage. So anyway,
yeah, I'll
stop and let you go someplace.
And I like the common threads that you can pull, especially around technology, and how that's a common theme that comes up time and time again in your career. Well, I do want to bring up, because you mentioned it, ETFs. And I should note, I was reading your bio and you've testified, you can correct me if I'm wrong, I think you've testified 6 different times in your career before Congress, or around topics like decimalization, even you were mentioning, I think, soft dollars earlier,
mm-hmm.
Among, I'm sure I'm missing a bunch of them. Let's see. well, definitely on ETFs. I know that was one that I actually watched your testimony on that one. So I was kind of hoping.
Is that still out there? That's
It's out there on
like you have to go
C-SPAN.
back
Oh yeah, you
and
can
try
find it. You can find it on C-SPAN. It was in 2011. Yeah, I watched it. So I was hoping maybe because this was one of the reasons I wanted to bring you on the show after talking to Herb Greenberg on episode, I think it was episode 76 with Herb. He was mentioning some of the work you did with ETFs that's still very much relevant to today and what we're seeing in markets. So I'll hand it to you to kind of frame up the risk that you see within ETFs.
Well, so a lot of the things we've already talked about feed right into that. You know, the crash of '87, technology, instant access to markets, bank runs, you know, all the stuff we've seen. It's now hyperkinetic. And what's interesting too, I was watching your interview with Herb and I'm listening, going along, and all of a sudden he said some really nice things about me, which I'm thinking, who even remembers what I did? So I have these relationships with people because it was, and I'm still engaged and I'm still publishing. I think, you know, LinkedIn, you saw the stuff I'm writing about. And what Bob Litan, who is also an amazing human being, who was at the Kauffman Foundation with me. Bob was part of the Shadow Markets Regulatory Commission, the Shadow Regulatory Commission. So they advised the SEC. It was economists and policy guys who said, here's what you should be thinking about. And so Litan was one of the key guys who helped create the ETF industry in terms of regulatory pathways. So what most people don't know who invest in these different things. So what do you get in a mutual fund? Well, in a mutual fund, you put your 401k money in and you say, I want to be in this growth mutual fund. And you hire doing that. You get a portfolio manager, you get a back office, you get access to your records, you get the right tax forms to file, and they're buying with your money, say 50 or 100 stocks that represent the best of what that company represents. And they hope by buying those growth stocks, the market will outperform. They'll do better than the S&P, or they'll do better than the Russell 2000 index. The drawback to mutual funds has always been, and mutual funds do handle this extremely effectively. So in small cap funds at American Century, when I first got there, we charged an exit fee because if somebody was trying to sell a large percentage of a growth mutual fund that had small company illiquid stocks in it, we recognized it would hurt other investors if they were selling out and other people were in for the long run. So we would charge them 1 or 1.5 or 2%. That's not as common anymore, but it was an exit fee because they were creating a drain on the existing investors when they left. And again, they should be able to leave. But the other part of it that was not well understood, let's say that last year, you're in a growth fund, like, you know, let's say ARK was a mutual fund, Kathy Wood's ARK fund, ARKK. It was $166 at the top of the market in 21, with all of these amazing companies of tomorrow, because in 20 years, these will be the winners. One of these will be Amazon. That was kind of the theory. If you get one of 100 right and it goes to be like Amazon, everybody wins. Okay, well, so then ARK went down 60-70% and went from 166 down to 30. I think 29 and change last year. I think that's like an 80% decline in value. So now if I bought that at 166 and I'm an investor in a mutual fund and it goes to 30, I've lost 80%. But then on the last day, I say, get me out. And Kathy's got to sell one of her, if she had the ARK mutual fund, which doesn't exist, and she gets me out by selling a company that had a profit in it because she wasn't going to sell some of these $1.20 stocks to get me my money back. If she sold Tesla at a profit while everything else was losing money, I would then get a tax bill to pay taxes on my capital gains on Tesla in a mutual fund. That makes sense. So I've lost 80% and I'm still paying a tax because I had a taxable gain on one position that was sold to raise money for redemptions. Okay, does that make sense?
That makes sense. So the person who's leaving, that say they want to get out of the fund, the mutual fund, they have to pay the capital gains because in order for that person to leave, they have to sell the winner to pay that person so they can exit the mutual fund. So then that they also at the same time, while they might have a loss, they're also having to pay the capital gains because they had to sell the winner to pay it. Got it. So, interesting.
Yeah. So
why did ETFs?
Why did ETFs start? Well, many in the regulatory community thought that was confiscatory taxation, and it is. Mm-hmm. It is hurting investors that are workers all over our economy, who are teachers in pension funds and have mutual fund accounts. Now, those are deferred taxation accounts, but anybody who is invested in a taxable account has to do that if they buy a mutual fund. Okay. Where that really works would be, say, in a value fund, where, well, they would. I don't want to complicate it. So you get the gist. Well, with an ETF, it goes down and I sell it, or it goes down and down 80%. But they do all sorts of transactions every day, buying and selling securities within that basket, and there's no tax on that to the investor.
Well, a naive question, but why? Why no tax for the ETF?
Well, because, I mean, clearly it's better not to pay taxes. So ETFs were created, in my opinion. So I was front and center on the war against Wall Street market makers on NASDAQ. So a lot of the stuff that I described in terms of the FIX initiative, Instinet, Archipelago, what all those did is that, and I've had people inside Wall Street tell me that I was often, so there were a number of actions where they accused market makers of talking about clients. And I was told by some friends at the SEC that they were talking about us. But the irony is we were so vocal about what we did. I think there were 50 funds that were trading, but they all would attribute it to us. So we became the largest trader in the history of the world, and weren't, because nobody else was saying, well, we're using these platforms. Okay, so I have to bring this back to the market makers. Then what the market makers did back then is that they were buying from me. If I'm selling something, they would then mark it up and sell it to B because, quote, it was a dealer market and they got a dealer spread. Well, back in the 60s, when you had stock certificates being bicycled across town, when you had stocks that didn't trade and I would sell it to you as a market maker, you might have to hold it for 3 or 4 days till you found the other side. So the dealer market was very different, even though technology stripped away all of the historical utility of dealer markets. The rules didn't change until the decimalization and the archipelagization. I love archipelago as a name, right? So it's a chain of islands. So back then you had Island was a great big disintermediary of the NASDAQ market makers. Instinet was number one. They were the elephant. And then Jerry was the startup with Archipelago, which quickly became a really effective platform and our number one platform. And
you were working on that decimalization because before it was in fractions. Can you explain that for folks? Okay, explain how it worked before and like what decimalization did to make it better.
So when I so that was Steve Wallman at the SEC who made that happen. Wallman was a iconoclastic. I think he was a Republican member of the market reg commit of the SEC commission, and believed that decimals were really important, and that's something we'd been preaching to a lot of people. And the reason is that I used to have a trading card. So Wall Street said you can trade stocks in eighths and in quarters. And then Instinet allowed you, because you had to trade in fractions, to trade in 16ths, 32nds, 64ths, and 128ths. So can you imagine trying in your brain to figure out what? So when I went to Congress I basically said, why do we need decimalization? Let me ask you, everybody, we're trading stocks. Can you see this? And I made this great big card, and I had the guys, they looked like they came from Men in Black. I had an artist at our company draw them in these big suits with big sunglasses. And then they were holding up these 8s and quarters, and it was like 12.5 cents and, 0.0625. It's like, why do we do this?
You made them do fractions, basically. You're taking everybody else back to, like, I don't even know when we were doing fractions in school, but I probably hated it. Yeah.
And so, but it allowed for the dealers to maintain a dealing edge, even though my argument at the time was, you looked at London or you looked at Paris, they were trading in pennies over there. So they were trading in units of 0.01, whatever the local currency was. So I'm like, why aren't we doing that here? And there was all of this, it was, the thing that just hit my brain is that I was thinking about how I learned how Washington worked. So I was a member, American Century was heavily involved in the Investment Company Institute, ICI, which is kind of a beltway trade interest group for the buy side. And I helped them put some things together. I got to know Gus Sauter really well there. Gus, who used to run the Vanguard Group. He started as a lowly trader like me. So I was invited to an ICI dinner. And at the time, there was a rumor, before Arthur Levitt was appointed, it had just been the transition in administrations. It was rumored that this lady who worked for a congressman, I think she worked for John Dingell, Consuelo Washington, was going to be this SEC chair. So, and a guy who worked for Ed Markey, Tim Ford, and I knew who they were a little bit, and I kind of got him beside him at the chow line, and I sat down with him at the table. And as we were talking, Tim introduced me to Consuela and said something about soft dollars, and she said, "Can you believe that? I read an article in Business Week last week. This is unbelievable." And I'm thinking that Washington has this sense of how things work, the market mechanics. There are all these people, I'll call them conspiracy theorists, who think that there's some grand plan that's designed to upset us all. And my sense back then was, these are just people who are overwhelmed with information. Like today, I'm really overwhelmed. Back then, it was not quite so overwhelming. And yet they're deciding what matters based on what's in Business Week. That was, to me, kind of really, really interesting. And it may have been my journalism background that made me kind of see that or open up. But that's why I then began for the next 20 years to work a very positive, I was almost a public relations oriented buy-side head trader, which was weird. Mm-hmm. And that went through. So bring it back full circle. ETFs, we're going to avoid tax. We're going to set up these ETFs. But really, why? Because ETFs are created and destroyed by market-making firms doing market-making activities that are ungoverned. They're really not regulated still. And the associated parties are the people that say the big sponsors of ETFs. So there are 3 or 4, everybody knows them. The spiders. There's an ETF sponsor. So they say, we're the marketing agent, we're the custody agent, it all stays here. But the trading day-to-day and intraday, that's done by our associated parties. They're now all electronic. At the beginning, they were not. At the beginning, they were all the former NASDAQ market makers who are now going to make the markets in ETFs. In a way, in a very real sense, the way ETFs are discussed and presented is a passive investment where people put their money in and just leave it alone forever. In truth, they were never that way, in my opinion. They have always been used as a form of portfolio insurance. And today what's changed is the democratization of the stock market, the instant access to bids and asks of unlimited size, the ability for folks like Schwab and TD Ameritrade, now they're together, interactive brokers to be able to say you can't trade anymore because you're at your limit, so you're shut off. That didn't used to exist. That was all done in the back office or upstairs. And I remember back in '87, the upstairs folks running down to the floor because they just gotten a report that John over here has traded 5 times more than he should have. And that all is now done by technology upstairs. So it's pretty amazing how that's all happened. But the ETFs, and I would go in, what Herb brought up in his show was the KRE, which is the bank ETF fund. There are, I don't know, I can't remember. He actually had it at the top of his head. So he must have gone to validate what I was saying. But I think there are maybe 200 banks in there. And the banks are all mid-cap, regional, and non-money center banks. Many of them, outside of the top 10 or 15, trade sporadically and poorly with wide spreads. Well, if you're not able to redeem, that's fine. But I did a back of the envelope calculation that showed that the market makers in there who create and destroy these things based on what customers want. So if customers spend 2 years or spend all of last year buying banks because they said rates are going up, net interest margins are going to increase, we want to own the banks. Not recognizing that zero interest rate bonds suddenly become, a bomb tethered to their legs in terms of their being upside down the yield curve. So last year, these ETFs grow and grow and grow. They've actually been growing probably for 10 or 15 years. And everything's passive because it's just an allocation. What's happened in the last few years is that the financial advisors, this is my observation. I'm sure there are smart people who will comment on this interview who say he is crazy. But my view is that financial advisors all believe that they are doing tactical allocation, and there are tactical allocation funds who use relative strength triggers and other forms of quantitative timing that will come in and out of a group, but they don't want to take the risk in the individual securities, and they don't do the research on the individual securities. So why does that matter? Joe Stiglitz, back in 1980, won a Nobel Prize, was one of the guys who talked about the reason indexation works. And I sat at a couple of meetings during my career with Jack Bogle when he was still alive, and at the ICI. And Jack was hugely critical of all of these, even at his own firm's products, because the ETF, the indexes and ETFs became, he believed that the broad market is what you bought when you indexed. He believed the S&P measured the total allocated sum of the market. And then you start to do this for biotechs and bank ETFs and micro caps and mini caps and micro mini caps and micro mini cap biotechs. This is all about setting up trading strategies and has been for 20 years. Paul Kudrowski and I used to talk a lot about this. Paul was at the Kauffman Foundation with me. And they would set up trading strategies. So you would see these little ETFs pop up. Many go away. They go nowhere, they die. But it creates all sorts of arbitrage strategies between the common security and the ETF, combined with options, sometimes futures, and what I would call portfolio hedging techniques. Most of the time, it doesn't matter. But when you end up in a situation like we had a month ago in March, 2 months ago now, and rumors go out that, they're watching the KRE. There were rumors that started to go out that there were big losses on bank balance sheets, and the KRE goes down. It went down. I didn't revisit before the show what the numbers were, so I've forgotten. But I think it went down 50 or 60% over the course of 3 or 4 weeks. And can you see that? Are you able to look at that there?
I'll pull up a chart of the KRE right now. I always post a chart. Do you want me to look for what?
Yeah, look at February. Where were we at the end of February?
Yeah, you can see, okay, I'm looking just like, you can see like the drop was precipitous. So let's say end of February 2/28, 2023. It was, it opened, it closed at 61.56 at the end of February. And then you see, go through March, you just see it drop like March 13th, and it closed at 44.45.
What's the low of the whole move?
The lowest it went. Okay, let's see. Look at the lowest. I think it was 30.
I think it went to 35 or 33.
36.08. Yeah, 36.08. Yeah.
Okay,
and right
so
now
36
it's at 40,
divided by 61 is 42% in a month.
Yeah.
So if it went down 42% in a month, that's one thing if the capital stays stable. So they're just selling the mutual fund or selling the ETF. But if down 41%, the other thing you have to look at is how many units were destroyed during that time. So as financial analysts go, get me out, or Wall Street firms, or big mutual fund managers who just wanted to have a little bit of banking in their portfolio. You know, they're all. The other thing we want to talk about, I think, is the whole professional money management industry is basically corrupt now. When I say corrupt, I'm not talking in an evil corrupt as in a rusted, broken, can't work way, and it's incentive compensation, which are all typically tied to information ratios or public benchmarks that are mentioned that the SEC made people put into their portfolios 25 years ago. So as soon as you put a manager in a portfolio and you say you're a value manager and you realize that 21% of your benchmark is in banks, and I'm making this up, right? I'm just thinking out loud. Now, all of a sudden, if you don't have banks, you're making a big active bet. But you may not like banks, or you may think, I just want to make sure I'm neutralized to that factor. So I did a lot of quant investing. I worked with a lot of quantitative, and we did fuzzy logic and neural networks and evolutionary programming techniques. And they all start with a benchmark. So either you're trying to beat the benchmark or you're trying to neutralize yourself against the benchmark. So if you're going to ask me today, why are growth stocks moving up? It's because all the growth stock investors weren't in growth stocks. They were hiding out in defensive places. And now they're looking at their lagging returns for the first 5 months of the year. And they're going, holy moly, Batman, how do I catch up? I can't. Okay. So these factor bets are getting faster and faster. And that's where my view is people came running out of the banks. So the ETFs, which are all made by these associated parties, Wall Street trading firms, Susquehanna is a big one. Again, I'm not saying any individual firm, but these are the guys who run their arbitrage desks. And the way the arbitrage desks work is they're like, okay, we got all this money to buy KRE today. We're going to put the units together, and then we'll deliver them out to the sponsor. Same thing happens on the other side. They're coming out. Those have to be destroyed. Well, how do they get destroyed? Well, the stocks have to be sold. Either you sell the KRE or you sell the stocks in the KRE. That's the portfolio hedging part of it. So now you're trying to liquidate in a panic this ETF in banks. And there are a whole lot of these little banks that weren't trading very well in February at all. I went back and looked at that data. They were trading, I would say, very illiquidly with wide spreads. So somebody would say, yeah, but look at how much volume there's been in the last 2 months. Well, yeah, that's because they were down 50%, 60%, 70%. So the ETF is a package that is filled with a variety of different things that are some easy to trade, many not easy to trade, but you're giving the investment community globally access to instant liquidity in an ETF. But the component securities within that ETF are not instantly available liquidly. Mutual funds handle that. Hedge funds handle that by having a gate for redemptions. So when I was at Kauffman, a hedge fund would say, we'd love to have you as an investor, but if you want your money out, we have a lot of illiquid things in here. You get 45 days. You got to give me 45 days notice, or I'll give you 2 windows a year. Well, that's all about not destroying the returns for everybody in there.
Mm-hmm.
If somebody's trying to get out because, I don't know, they made a mistake in their investing, or they want to, they need cash for something else. I mean, there are a variety of reasons, or they just don't like that manager and they want to go to another manager. So they gate the redemptions. In American Century, we gated the redemptions for our mutual funds. We also have what was called redemption in kind. So the way you stop the run is I say, Julia, you sure you want out? I want out of your fund. Okay, here are my 10 worst stocks, most overweighted in volume. Take them. You sell them. Okay. Well, now that changes behaviors quite a bit.
Yeah. And
in
also,
the ETFs, this doesn't exist. There is no gating. It's instant liquidity. It's a feature of the system. And now you add on top of that massive, massive, massive trading volume in options. So the first thing people did with KRE, so think of this as, okay, KRE is this single security, which is really 245 individual securities. And you say, I'm really worried about the banks. I'm going to buy puts. Well, what happens is if you buy puts, which means you're making a bet that the market's going to go down in the options market, the options market makers say, okay, well, I'll sell you the puts, but I'm not going to do that just on a bet. So they turn around and do what's called delta hedging. Okay, what is a delta hedge? A delta hedge is basically saying, wow, I can't afford to get wiped out, so I need to own, if I'm going to sell puts to these folks, then I need to be short the stock so that I'm matched, because I'm hoping to get some volatility premium, I call it fear premium. So the more afraid people are, the more expensive puts will be. So there should be an advantage that you could then, sell the fund against that to hedge your downside. You know what they called that in 87?
No, tell me.
Portfolio insurance.
There you go.
Okay, portfolio insurance caused the crash of 87, according to government papers and studies. So I'm not saying that this happens all the time. In fact, I'm invested in a great Kansas City company that uses ETFs. They do it in a very systematic way, broad-based, broad markets, global. Okay, so I have my own money there. I'm talking specifically about what I would call are these they are not wired for panic events. Narrow, gold and silver are another one that I worry about a lot.
Like the ETF. I would love to hear more on that, because that's been a curiosity of mine. Would love to hear more on that.
Well, so the ETF, the gold ETF, the physical gold ETF is one of the largest holders of physical gold in the world, ranked with the central banks. I haven't looked at the statistics recently, but the overall open interest of the futures markets, the claim on the assets in the ETF markets are massive compared to the overall availability. So we are in a fractional reserve system. Okay, so what does that mean? Fractional reserve, just like the banks.
Yep. Fractional
reserves mean that I have $100 in the bank. I know that statistically, during most normal times, not when the Fed is raising rates, unprecedented levels over 6 months, but in most times, more than 10 or 15% of the money will never be on. Nobody will need to see that. So I would not be doing my job as a banker if I wasn't trying to make that money work, because what's an interest payment supposed to be? Even though it was 0 or 0.4 or 0.025%, that's a return to investors for my good investing of their money. That's also been kind of corrupted, I think, in the banking industry. And I'll tell you, the guy I would talk to about that is Ramon de Oliveira, who's been around for a really long time and started off. He's given me lectures on what banks used to do. Ramon is somebody I got to know very well at American Century. He was the JP Morgan head of asset management for a while, for many years. Go ahead.
Oh, no. Can I ask you, I just want to hear about the gold or silver ETFs. This is kind of my naive question for you. Okay. So if there are more folks that want to buy that ETF, they want more capital flows in, does the sponsor of the ETF, do they go and buy more physical gold, like the underlying asset to the ETF? Just wondering if like, does that match up? Or maybe that's a bad question.
It is. That is a very complex question, depending on who you read and how they think about things. I would say that it differs based on different approaches taken. And there are things like trusts. I would say that the Sprott Money Trust in Canada, they actually own vaulted silver and gold. It's not lent or they call it, I love the terms too. I had to learn any of this stuff, you have to be curious, because what in the heck is hypothecation? What does hypothecation mean? Hypothecation means that I take something I own in the capital markets and I lend it to somebody else. Well, instead of saying there's leverage here and I promise something to somebody who may or may not have the money to pay for it, it's called hypothecation and rehypothecation.
Okay.
Whenever I see the language like this for my whole career, when I see the language like this, I always think there's trouble where the language goes away from communicating exactly what folks are doing for what reasons. And in ETFs, for instance, one of the primary ways the sponsors earn money is through the margin lending that goes on against portfolio securities. All of these things are huge profit centers because of lending activities.
Can you explain that? I would love to hear more on that.
Well, the best, so I can't. I have talked to some of the biggest leaders. So Mohan Verdi used to invite me to his conferences in New York, where he would literally have me dance off with the ETF sponsors. And they would argue with me to the death on the panel. And then when we would get out into the hallway, they'd come up to me and say, "You're really right about this, but we just can't talk about it." So there are big margins earned, because most of the time the ETF buyer gets no claim on the margin interest from the portfolio lending that would go to people who are shorting the stocks. So they go and they say, "Okay, I'm going to short stocks. I'm a hedge fund. I'm paying my margin interest today at Schwab is 15%. So if 15% is going because I'm borrowing money to trade, and the ETFs can drive that because they own the securities in portfolio and they're not sharing it with their investors, then it's a huge source of profitability. Huge source of risk too. But again, there are so many. The reason I was a huge fan of electronic trading is that, Julia, you want to buy, I want to sell on a computer, we meet each other and we do it. In the old days, it took 6 people. And we've had the lending folks that lend to shorts with massive margins to lend to shorts around forever. It's part of the, quote, one of my least favorite words, but the ecosystem. It is how things are supposed to work. And I think the more transparent, the more direct it is, then the fairer and the better the market's pricing rationale is. So, all this could get to be, if you have somebody listening to this, their eyes are going to glaze over. Believe me, it is complex. It is intentionally complex. And as I've said a couple of times, it's a feature, not a bug of the system.
Yeah. If we kind of zoom out just to understand like ETFs, how are they distorting markets, and do they pose, like in your view, do they pose a systemic risk?
Yes, just what we saw in KRE. I think that was, I don't know. So if I'm a portfolio manager and I own PacWest, which is one of the largest holdings in the KRE, and the KRE starts selling, it may be that PacWest has a problem. But the intersection of the fundamentals of that particular bank and a panic out, seeking liquidity to get out of an ETF, can exacerbate the whole problem. More importantly, most people who believe in technical analysis, which I do, I did a lot of testing on that at American Century. We believe charts. We used to get the old O'Neill charts, came into our office in a great big, 13 by, I can't remember, they were huge books, and they got delivered, and That's back before FedEx and UPS were on the street every 2 minutes. And they would draw on the charts. All that's now electronic. You probably have a chart right there in front of you somewhere. So the systemic risk is, systemic risk means that you create a panic that's uncontrollable or costs a lot to fix. So I wrote a post on LinkedIn where I laid out what I thought happened the day of the bank failures, or the days leading up to the bank failures. I articulated a couple of things. One, I said it wouldn't be the first. I think we've just started. And two, the systemic risk part of it is that technical analysis, which is now being used by most of the major Wall Street firms using AI, right? Because why? AI is saying we're going to look at signals. So in the old days, they said we're trying to distill signal from the noise, right? So signal to noise to signal. That's what AI was about. And I was doing that stuff with some brilliant electrical engineers, back in the middle to late 90s. So, or in the early 00s. And the idea was that technical charts, so if you're looking at a moving average, you're looking at volume, you're looking at price of a stock, that it's telling you, so here's the naive idea. Somebody else is doing that research. I don't have to. I can see that in the price on the screen. That price on the screen represents what smart people think about this from a fundamental perspective. So they've done the fundamentals. They've looked at the cash flows. They've looked at the DCF models. They're right. Okay. And yet we've got semiconductor stocks trading today at 50 times revenues that are hundreds of billions of dollars corporations. And if it's 50 times revenues, that means that it will take 50 years and no executive compensation and no cost to run the business and no competitors to pay you back your investment. None of this makes sense. I believe it's all what ETFs have done to undermine price discovery done by good evaluation of the company's fundamentals and future prospects. Okay, that leads into the systemic risk issue because people are using ETFs as, quote, a diversified basket. And what happens in these when they're narrow is that if money comes into say a biotech ETF, then they're all most of them are capitalization weighting. The KRE is pretty much a lot of it's equally weighted. The XOP, which I trade, is equally weighted, but the XLE is energy is a cap weighted index. So if people are making bets on the energy market globally and they're buying the XLE at a hedge fund, what it means is that the creation units that are created in response to them wanting to buy the ETF are buying the largest securities. That's what a cap weighted index means. The largest companies have the biggest component weight. Another example of that, you and I talked before the show about XLY, which is the consumer discretionary fund. In that, there are, I don't know, I'm going to be wrong. Somebody will criticize me, call it 100 stocks. But in it, all of the best consumer, Ford, GM, Tapestry. I mean, you can go through a whole list of discretionary. Consumer discretionary would be like, and retailers, what customers buy. Consumer discretionary is quant speak for, okay, when a customer in a recession, if the customer's money's tight because of inflation and they got laid off, they're not going to buy discretionary stocks, right? Well, the XLY index today is over 40%, I believe, in two stocks, Tesla and Amazon.
You're right. Amazon at just north of 25% weight, and then Tesla just north of 14% for the weight.
It's only 39%, but Tesla's up like 2%.
There's some percentages there. It's like 14.43 for Tesla and 25.16 for Amazon. But yes.
And then Home Depot, I think, is number 3.
Yeah.
And then
right.
After that, there's a drop off, right?
Yep,
so it's all about.
Yeah.
So the bigger the company gets, the more money it gets, which to me undermines the whole notion that capital should go to the most efficient stewards of capital. That's not what's happening today. Most of the money now, most of the financial advisors have tipped from even pretending to do fundamental they're all doing asset allocation models. And so in doing that, more and more money is going into these passive strategies, which are cap-weighted index driven. So the biggest companies get the money. If I buy $1 of that index, 40 cents of that dollar is going into 2 stocks.
Mm-hmm.
So, and again, it's hard to explain all this. I hope I'm coming at all close to explaining it.
No, you're doing a great job, and it's interesting because I'm just thinking out loud here, and I'm by no means an expert. So let's say I have my individual portfolio. Maybe I already bought shares of Amazon and Tesla individually, and I might think, oh, like, okay, I want to be diversified. Let me buy this ETF. Well, if I bought this consumer discretionary one, I would be basically buying Amazon and Tesla all over again, wouldn't I? So
yeah, at least a halfway.
Yeah. So I guess my following question, because if there's a lot of names that appear multiple times in multiple different ETFs, and you might think you're diversifying across a bunch, but you might be owning the same names multiple times. Does that create, I'm just thinking because you have just more and more demand for all of these, whether it's through an ETF or buying individually, could that create like asset price bubbles for some of these names? Okay.
That's what my whole paper with Bob Litan was about in 2010. That's what we did in 2021.
Do you think
so? I owned a company that came out of a venture capital fund back on the West Coast that was included in an EV ETF and went from $3 to $34 in early 2021. Today it's $2 after a reverse split. So the question is, how much did the ETFs and the money going in? Now we're doing an AI, right? So you're going to see, AI ETFs just spring up because the new buzzword is AI, right? AI has been around for 30 years. It's gotten the data's gotten increasingly more robust, but AI is nothing new. I think the whole idea of singularity and what these tech guys, are convinced is the crossover where the computers will not need man because they're smarter than man, and they'll learn. They'll use evolutionary programming and annealing algorithms to defeat man. I'll believe it when I see it. Most of them are a function of their historical data sets and how they're trained, which is why Elon Musk was out 3 or 4 weeks ago saying, my big worry on AI is it will be influenced by how they're trained, a liberal or conservative perspective or viewpoint, a progressive or a whatever perspective will train the text-based AI differently. The other part is we don't have, so I learned this at American Century because we were trying to do all this work and the data only went back 8 years. We happen to have an internal database that went back 25. But all of the data that we have that's being used to train all of these systems has only been in a way to understand or really look at it for maybe 15 years. And we're talking about 3,000 years of history and climate, or call it 30,000 years of history and climate, 10,000 years of history and civilization. We're basically suggesting that everything that's known can be captured and analyzed and acted on by these systems. And again, I kind of got off track there, but go ahead.
All good. You're totally allowed to do that on podcasts.
So I was going to go back. I'm sorry to
go for it.
Step on you, but you asked me what was my worry? I worry that increasingly good company managers are not rewarded for good company stewardship unless they're in an index. And then so there's a view in the quant land that one semiconductor stuff is related to all the others through high R-squareds. This is, all quant talk. So high correlations. Well, if you believe that all semiconductor stocks perform exactly the same way, over a very long time, they can break out, but it's becoming increasingly difficult. And when Joe Stiglitz won his Nobel Prize looking at indexation, he said the one thing he worried about is that if indexation or passive investing, which is economists call it free rider problem. So why do the indexes work? Because they're free riding on the economic work that used to be done by small cap, mid cap, and large cap portfolio managers and their teams of analysts. Well, if now 70 cents or 80 cents out of every dollar are going into passive funds that are, quote, riding on the what used to be the 70 or 80% who are doing the fundamental work, and now they're 20 or 30%, there's no incentive for them to do the work. And I already talked about the portfolio compensation problems. So that if I'm paid to beat the Russell 2000 index, either I take crazy risks by not owning any sectors or a couple of sectors that are in there, or I'm going to try and neutralize my looking too bad so I don't blow up my bonus. Well, I think you can probably bet where I used to be with my American Century folks, we thought our system would drive us to where we go, and we were sometimes wildly different than the index. That's the only way you can win. Most of the industry will run what I would call a tracking error of 2 to 3% around their portfolio benchmark. So let's say their benchmark was the IWM, the Russell 2000. They might have what looks to be an active portfolio, but because of their sector bets and their individual company bets and size and the correlations of these securities, they're only running a real 2.2 or 3% tracking error, which means that in most years, they'll only be 3% better or 3% worse. If they've got a good marketing group, they'll explain when they're worse than 3%. You've got Morningstar, who's given them 4 or 5 stars if they're consistently better. But a lot of it is narrative fallacy, behavioral finance, and the active guys use narrative fallacy, but they pay their folks using plus or minus to the benchmark. So if they outperform the benchmark, they get a big bonus. If they underperform the benchmark, they don't.
So I get the sense that equity markets are broken. And I think you've seen this for many years, and your testimony was in October 2011. So I guess my kind of question for you, Harold, is we'd love to hear if that's true, if you think the equity markets are broken. And if so, how do you invest, or how has that shaped the way you invest, if you're willing to go there?
Well, so I've already confessed that a portion of my assets are in. One of the things that I did as a CIO at Kauffman, right? We were invested in hedge funds and private equity and around the cycle. So I would say that public equities are not a huge part of my overall portfolio. I do trade options, and I don't want to talk much about that because it's a methodology that was surprisingly effective during the bear market, and yet I wasn't shorting stocks. And it's around math and probability, right? So the markets offer math and probability, but it's very boring. So you can make money being very boring. Here's the other thing I would say. I have a portfolio where my positions doing this boring math are small. I couldn't do this if I worked for a bigger organization because there's not enough opportunity set the bigger your assets go. So if you find something that really provides a lot of alpha, alpha is excess returns. So quants talking, beta means my thing will do, if the market's going up, I'll do a whole lot better because I have high beta. That means I'm going to go more. So a high beta fund might go up 50% more than an S&P when the markets are going up. But a high beta fund will go down 50% more when the market's going down. Alpha is all things being equal, I'm going to give excess returns given the risk that I'm taking and beat the benchmark that people want to beat. I do not believe that a fund today with more than $1 billion, I believe this 10 years ago, if it was true 10 years ago, it's even truer today. If you have more than $500 million in a fund under management, it completely corrodes your ability to win. So why do I say that? We did 50 years of testing, and we learned that all of our returns came from a portfolio of 10 stocks, none of which you could discount up front was going to be the 10. You had to let it grow. Now you have all sorts of folks who hedge it and they trade out. The liquidity is not big enough. They can't buy a big enough position. So What I'm doing is I'm buying a portfolio of 10 stocks. I'm doing the old American Century stuff because IBD gives that to me. The Investor's Business Daily gives it to me for a few dollars, what used to take $2 million a year to run. I used to have to run, we ran 24 PCs, back then it was a big deal, 24, 3 CPU units, 24 hours a day, crunching all these numbers to come up with our portfolio list. Well, today, Amazon will do that for you for a few $100. That was an $11 million investment that American Century made way back when. So the first people to do that spent a lot of money. Now it's easy. And I would say I won't put my money by and large into big funds that can't work, which is why for the money, I'm not managing myself for diversifications with a large firm that has an incredibly positive reputation in Kansas City, and they're an ETF manager. Does that make sense?
It does make sense. Yeah.
Or am I not answering the question?
No, it makes sense. I like that, you know, it's more difficult today to manage like huge sums of money. It makes a lot of sense.
Well, you can see immediately that every trade is captured in one form or another. There's another worse issue. Today, back then, if I was trying to buy 2 million shares of Oracle, which I did 100 times if I did it once, using the street, you could see the tickers, but there was no computers tracking where the volume was. And right now on my TD Ameritrade Thinkorswim platform, I can see immediately if there's what the trailing 50 days of volume is, and whether or not today's volume is 3 sigmas or 2 sigmas above that 50 days of volume. Well, that's live time. It's instantaneous. So now if I'm trying to sneak into a position and I'm a huge mutual fund or a huge ETF, you can't sneak into a position without leaving huge footprints because everybody's looking at every footprint.
That makes a lot of sense.
If you're small,
too. Yeah.
if you're small, you can win. Then the last thought related to that is back in the day, the market makers on NASDAQ would call each other. There was a lawsuit, a big court hearing, and a lot of these guys were fined because they would call and talk to each other about the orders that customers put in. Today, there's no way to regulate it, I don't think. The volume starts to spike on, let's just say there are 10 stocks, but I happen to like a stock named Rambus. Rambus is a fabless semiconductor maker, was up 11% last week on one day, just exploded. And the volumes increased rapidly. Well, stocks like that are now being watched by 1,000 people who buy it, and then they go out on Reddit and say, love this stock. And then Reddit, all these folks are trading fractional shares and options, and the amount of activity around these things exacerbate the whole move. Which gets to the other thing that I think is happening. We were talking this morning, we're just mystified at these stocks that are just melting up in the trading room I'm in. And I'm in with some really interesting guys who've had some really amazing careers. And we all just became friends through a variety of other things, and we share a trading space.
Yeah.
But when the whole world is fading the Fed, is trying to play the Fed by being short, owning puts, being out, waiting for the crash, and all of a sudden the crash doesn't happen, I'm looking at chart after chart that in my old days of chart studies, I'm like, how can this be happening? This makes no sense at all. And, you know, again, the market won't go down as long as everybody's expecting it to go down.
Wait, why do you think, why is that?
Well, it's very expensive to be short. If you have puts, you're paying a huge premium. You were paying volatility premiums. Okay, so again, I don't know how most of your investors are trying to learn, or your listeners are trying to learn
but
stuff.
It's okay. You're helping me learn too in the process.
Okay, so options, right? There are two things that drive the intrinsic value of options. One is the time that's remaining on the option, and the other is the implied volatility of the option. And there's a discount factor involved, right? So the Black-Scholes model was the original driver. And of course, Benoit Mandelbrot, who wrote The Misbehavior of Markets, one of the best books ever written. So I have several books that your folks should read. But The Demons of Our Own Design by Richard Bookstaver, and then Misbehavior of Markets. Those are both circa 1999 books that were written and really, really, really matter. They're very, very informative. But he made fun of, Mandelbrot made fun of the number of Nobel Prizes granted to options theory, most of which were used to correct the previous Nobel Prize option theory that was wrong. So implied volatility last year for people who bought puts, and I did it and lost significant amounts of money every time I tried. The volatility was implied on the XLY, for instance, of about 45 or 50%. ARC's volatility last year at times went to 80%, which meant the anticipated move of that index would be 80% at the end of the year, up or down. Well, when you're trying to buy protection to the downside and it's costing you that kind of volatility because everybody else is afraid, you can't afford to hedge it. So if you're paying 15% to be short and you're margining that position, you better be damn right and quick and understand that it's going to happen right now. And when it doesn't, then the costs of missing out. And again, my point is what's going on in the NASDAQ part of the market right now. I sent you a chart earlier today, which showed they call it the gamma explosion, where the NDX index last week had one of the most incredible single-day call buying frenzies of ever. And the chart, I think, went back like 20 years. So when call buying is coming for these, and it could be fractional, it can be, small, it can be ones and twos and tens and 20s. If you're short, you're trying to get it back, or you're trying to hedge it somehow. And when the markets become illiquid, as they are right now, I'm worried there's illiquidity everywhere. When the Fed turned off the spigots, so right now, M1 for the first time in history has turned negative. Well, one would expect that after, M1 is the amount of money in circulation. After a massive creation of money by both the Congress and the Fed, one would expect it would turn down because we created more money in the last 4 years than in the last 100 years before that. So, what that does is when liquidity is leaving the system, I think it makes everything more fragile. We've already read about the bond markets being more fragile. Bids and asks are widening out. That's why people are worried about a crash. But the other part of it is if spreads are this wide and you're now, I'll do it this way. So here's the ask and here's the bid. And I just sold puts down, or I bought puts down here. But to get out, I've got to pay up here. All of a sudden, those spreads widen out and it just creates a chase because there's not a free and liquid trading going on. Part of that's what ETFs have done in individual stock categories. The ETFs, massive volumes around those, far bigger than what's in the underlying portfolio, the portfolio securities. So, these are all kind of
Wait, that's interesting. So ETFs have impacted the liquidity?
Well, again, the ETFs have a call on liquidity that may not exist in those individual securities packages.
Oh, got it.
Which is what I described in the banks.
Gotcha. That makes sense. You've been kind of sounding the alarm on the systemic risks posed by ETFs for well over a decade at this point. Do you think anything will be done to remedy it? What would be some of the solutions that you would propose?
No, I don't think anything will be done because I think that the political system is driven by folks. Every meeting I went to on Wall Street as a buy-side firm, it was one of me and 6 guys. So the Market 2000, it's interesting. Arthur Levitt's group, a guy named Howard Kramer, who just retired in Washington, was on the staff and did what was called the Market 2000 paper. It was published in 96 or 7, and they asked for people to call and respond to questions about electronic trading systems, liquidity, technology, regulation. And at the time, there were, I think, 34 responses, 3 from buy-side firms. One was a one-pager from State Street, and mine was a 60-page piece done with data, which is why they asked Bill Lyons, who was the CEO of American Century at the time, or the general counsel, and me to get on a plane and go back and sit down with him and explain our paper. The political lobbies in Washington, of which many of our political leaders are financed very heavily by the folks in the canyon on Wall Street. And they get paid in transactions. They don't get paid to invest and grow. They get paid to tell people what to do to invest and grow so they can get paid in transactions. As long as there are lots of transactions, there are lots of people taking money out of the pockets of the buyers and sellers of securities and of options and of other, quote, innovations, most of which are not what I would call innovations. I'm not sure how we get people to understand that underwriting, for instance, if we really wanted to solve some of this stuff, let's fix executive compensation problems in common stocks. It's a disaster. It is absolutely misaligned with investor interests. But if you're in an ETF, you don't care what happens to the executive compensation packages at stocks in the portfolio. I would dramatically limit the use of zero-day options trading. I would dramatically limit the number of options that can be traded around the core number of securities that are in free float position for a company. If that makes some things leave indexes, so be it. The capital allocation decisions can't work when companies are flung around. Let's look at I'll bring up the GDX, the gold mining index. I don't know whether there are 60, 70 stocks in there. I think it's probably had 10 moves in the last 6 months of 5% or more in a day. Do we really want to think the fundamentals have changed 5% or more in a day that many times in the last year? It's all about things unrelated to the nature and character of executive leadership and management, growth of the company, and efficient capital allocation. It's been divorced from the market. So how do you fix it? I'm not sure. I think that until we get derivatives under control, which are all many multiples now. I mean, it was interesting on the stuff that Herb posted on ETFs. A number of people went even further than I did, saying, we've got $1 trillion of derivatives. You've got swaps on stuff, swaps on companies, all of this stuff that has a purpose, but is all sold separately in different verticals in the marketplace. So the only way to solve it is to be forewarned. But I also think watching what happened with KRE, it terrified me. And so how did they stop it? Well, they didn't change anything except to say we're guaranteeing the deposits at every major bank in America, basically, implicitly. Is that a solution? The solution is to rein in the speculative activity around the core companies. But that's not what we do.
It's kind of like
maybe too dark. I mean, maybe, normally I'm more optimistic and I've been an innovator. So,
but it's almost like we've gotten away from what the original purpose of the markets were.
That's a really good point that you make. So when I started, consumers and 401ks weren't a big deal yet, right? So now what we did is we transitioned from how can you retire if you don't own good growth companies? Because, man, these companies like American Century, 20th Century, that manage these amazing new companies like MCI and Baynet, Intel, back they were nascent little companies that when they grew, you wanted to have part of your retirement money in there because that's how you would be secure without Social Security. Today, that's not how we talk about it. We talk about it as investment. And capital formation is why markets were created. So let me go back to this. I think it was PacWest. I may have the company wrong. But they went out. They got destroyed because they said stocks going down hard. And they announced to the world that they're trying to raise capital by selling stock. That's why the capital markets used to exist. If a company needed to get itself squared away, they said, we've got a mismatch in our assets and liabilities. We're going to sell stock in order to create a more stable financial picture. And as soon as it went out, they were trying to sell stock, then all of the phones went out, all the people started hitting their keyboard, and the capital came, 1/3 of Silicon Valley Bank's capital came out, and I think it was like 2 hours. So it's run first, ask questions later. Well, how do the capital markets function like that? I was somewhat happy to see last week there was a very large broker dealer who offered $2 billion in notes to the market, and it went down 1/4%. That told me we were past the tumultuous stage right this second. I don't think we're done. I may be wrong about that. But again, Bill Hambrecht is somebody who I've admired for a very long time. Hambrecht and Quist, he actually financed Steve Jobs in bringing Apple to public. And Bill talks about, I read analysts who say this small company is coming to the market to raise money by selling stock. They're diluting investors. Small companies have always grown using the capital markets, common stock, which, by the way, have no claim over debt holders. If the company goes out of business, they go to zero. The use of common stock was a way to create a share of ownership for people to help a company grow, to hire more people, make more products, build. But now we've gotten into this, the ability for companies to raise money to grow by using capital markets has been subverted by ETFs, and it's been subverted by narratives around, quote, dilution. Dilution means that if you have 100,000 shares and somebody sells another 100,000 shares, that your 100,000 shares have half of the company's interest when you used to have 100% of the company's interest, just in a broad stroke. So if I had 100 and I sell another 100 shares, now there are 200 shares of which I own 100. Okay, that's a half. Well, if the company goes to 200 from here, I'm still going to do great. That's that whole idea of if you make the pie bigger, a smaller slice of the pie makes more money. But that's not how I think ETFs have subverted that some. So again, we're smarter about the way we do a lot of things, but I'm worried that we've lost sight of why capital markets existed in the first place. And that's what that 2011 paper was about.
Yeah. Well, Harold, I appreciate you coming on and being so generous with your time and your ideas and your knowledge. And I want to give you a few moments if you want to let folks know where they can follow you. I know you've been posting a lot on LinkedIn, or if you have any parting thoughts for the folks who are watching and listening, please take a moment.
Well, first of all, thank you for inviting me. Old dogs, right? So the one thing that I used to have was 1.5 million investors, which is why people had to listen to me. I'm still very engaged in talking to a lot of different folks who are in and around policymaking. And it matters to me because capital markets should be helping us grow as a nation. And right now, they're not. In terms of where to follow me, I may have something more to talk about later there. I have a friend who is very, very concerned about food security, who was in the State Department, and the two of us are talking about a video log or whatever we call these communications platforms now, where we're talking about food security, technology. He's concerned that we're entering an era of digital slavery. And these are all interesting things that affect finance. They affect investing, maybe infect too. Again, whether this happens, I don't know. But I'm not out there seeking an audience. I'm hoping you really build one, because these conversations, I was listening to one you'd done with an advisor earlier, and Herb just was really, really interesting in terms of how he walked through kind of the history of markets. Then the other thing I'd say is there's nothing new today, except that there are many people who believe the bubble we're in because of bad policy from the central banks, bad congressional policy, have us in a position that could be as precarious as we were in '09. And I think that will remain to be seen.
Harold Bradley, thank you so much again for taking the time. Really appreciate you coming on the show. Hey everyone, I really hope you enjoyed that video. Be sure to hit that like button, the subscribe, and that bell so you won't miss any new videos.